Welcome back. You're still watching Global Mantra, and I'm still in conversation with Jitesh Gadhia, Senior Managing Director at the Blackstone Group. Jitesh, of the nature of Hero Honda, where they've parted ways now, do you see more such so-called breakups in joint ventures happening, given that India is becoming such an important market for foreign players to kind of monetize individually rather than with a local partner?
Right. Well, I think what you're seeing is increasing desire of developed market players to control their own destiny in India. So you've been seeing that in the case that you mentioned, but also, frankly, you've been seeing some of the players that had listed entities in India increasing their stakes. You've seen 2 or 3 of those. ABB is one. There have been a few others in recent months as well that have been announced, and that I think will definitely continue. It's in an evolving market, partnerships have some value because they accelerate the entry of players into the market. They can sort of lead to transfer of skills and capabilities, but ultimately, as things mature, Indian players also, like to and want to go it alone and have more of the upside. So it's always tricky, but there are certain cases where partnerships can be a sort of have their own cycle, natural cycle, which is healthy for everybody, and people get what they want out of those relationships, and then they sort of have their own natural life comes to an end, and certainly in the case you mentioned, my understanding is that it's been a sort of relatively amicable arrangement, and the 2 entities will then sort of compete.
What about the IT sector? That's the other pocket where there's a lot of M&A interest, with the expectation that since, given the recovery in the US, you're going to be looking at the larger players holding fort. But for some of the smaller players and the mid-tier players, you would need more muscle power to kind of compete at the pricing level. From that standpoint, again, that's a segment that you're seeing a lot of activity.
You will see more activity in the sense that a lot of the IT services players outside of India still have a low element of offshore capabilities, and they increasingly realize, have been making investments and doing this on a greenfield or brownfield basis for some time. But the local Indian market is also becoming quite interesting from an IT services standpoint, interestingly. So it's not just having offshore capabilities, it's accessing the domestic market, because the enterprise sort of services sector in India, B2B, is big and growing. So I think that's what will probably attract overseas players into looking at the smaller mid-cap players in India. The other interesting thing is that really, if you look at the 3 or 4 large players in the Indian market which are global, they've mainly been growing organically. And the question really is, what point will M&A start to form a part of their strategy? And until now, they've had lots of organic opportunity, and they've enjoyed very high margins. And what stopped them really doing much M&A is that it will be dilutive to their margins and their growth. But there's only so much.
Where do you see the tipping point there?
Well, there's only so much you can do by adding people. You've got to be able to add really capabilities and intellectual property IP to the businesses, and I think that's where the tipping point will come.
Do you think by the end of 2011 you perhaps see these companies being more open?
I would think so, because I think they will also be more confident of their capabilities in integrating acquisitions, because I think you know, we as advisors, I think, need to be suitably humble about what we do. We only rarely do get involved in the first part. The more difficult part often starts where we end, having delivered the control or completion of a transaction. The real work of integration starts, and really India doesn't yet have that many real Indian multinationals, and the ability to integrate successfully and create a sort of a global multicultural management structure is something that is still evolving in India.
One criticism that deals in India have faced, especially the private equity space, is that most of the deals are pipe in nature, like private investment in public enterprises, which are listed entities, and they're not true blue private equity where you take complete ownership, you restructure the company, restructure the finances, cut costs, which is how private equity used to be traditionally done. Is that criticism fair?
I think it's not fair because it doesn't recognize the realities of the Indian market, and the realities of the Indian market are firstly that the promoter-based ownership structure means that companies are rarely for sale in their entirety. Secondly, the delisting process in India for public companies is probably the most arcane in the world. It's near on impossible to delist an Indian company. It's a bit like Hotel California. You check in but can't check out. And then finally, even if theoretically you could delist and do a sort of total take private, the ability to finance a typical LBO structure in India is still restricted. So rarely you see typical LBO structures in private entities, or what are called controlled transactions sometimes, but even those are rarely growth capital. And I think pipe deals are something that suit an economy that needs growth equity, and that's what it's often about.
And finally, Jitesh, just a sense of the potential of outbound deals versus inbound deals you see in India. A lot of the large cap companies have actually gone ahead and done some very major outbound deals, whether it was Tata Chorus, whether it was Hindalco Novelis. What about the potential of outbound deals versus the potential of inbound deals and the trends there?
Well, as you know, I was involved in the Tata Chorus situation personally, but I think for a number of years the outbound activity has outpaced inbound, and that's back to the ownership structures. Indian promoters typically don't like to sell. There's been some notable exceptions, for example, particularly in the pharma space, but by and large those have been exceptions. So I would still see, in terms of Indian M&A, a structural bias towards outbound. I think the inbound activity you will see will be a sort of hybrid between M&A and FDI, in the sense that it may be in the form of joint ventures, where take a company like GE, which has a large number of activities in India. For them, having been in the country for so many years, I assume they're reasonably confident in putting greenfield, brownfield investment, or doing it in partnership with other parties. In fact, they've already done that in a number of cases. So that's the sort of pattern of activity that I would expect on the inbound side.
So what would be a ratio in that value of $100 billion? How would it be skewed or broken between outbound and inbound?
Yes, remember there is also domestic. So it's outbound, inbound, and then purely domestic. So I would say that typically it has been sort of 50% outbound, and maybe that ratio will be there or thereabouts
for the Indian market.
Indeed.
Okay. Thanks very much, Jitesh. Thanks very much for joining us on this show. With that, we come to the end of this edition of Global Mantra. Thanks very much for watching.